earnings beats in the fourth quarter was 70%. The 3-year average is 76%. And then earnings misses 23%. The average is 15%. But the nominal numbers, maybe on a relative basis, aren't what they were, but they're still all positive. So I don't understand exactly if you call it a horrible season, Nick.
It's not a horrible earnings season. We would grade it out if we had to give a grade to it as a D. And the third quarter earnings season was a C, but the market was pricing in an F late in 2018. So these are better than feared. And it's all relative to the expectations. So the guidance companies are given after. We're seeing a greater percentage of companies lowering estimates after they report as well, and by a wider margin than what is normal and what happened last quarter. But again, the market was pricing in the numbers to significantly fall. They're just falling. And so that better than feared, the market prices are resetting higher as we're pricing in growth in 2019 to occur and not a recession.
For the first quarter, you think that we actually see earnings go down 1%, but what is that? That's less than what people were forecasting a few months ago?
That's correct. And some service providers are already saying the growth is -1% for the first quarter. The market at the end of 2018 was expecting those numbers, the estimates, to fall between 4% and to -7%. Because what you have every earnings season is 70% or 80% of companies beat estimates by about 3 to 5%. So to get negative earnings growth in the first half of 19 and the first quarter of 19, that's how far the estimates would need to fall, and they haven't fallen that much. So again, the estimates are coming down, but not nearly as bad as feared. And that really sums up fourth quarter earnings season so far.
Is that your take on this, Mike, or just a little bit?
I mean, the spread, in other words, the amount by which companies are beating when they beat has been narrower this time. It's been lower than the 1 and 5 year average. I mean, you can look at it as essentially they've cleared a lower bar. That is true. The first half of this year is, in terms of the formal estimates right now, trending toward basically flat profits, no growth. You have a slight decline. But as Nick said, if companies, as a matter of routine, beat the final estimate by 3 to 4 percentage points, then you're talking about probably, if things go as they stand right now, very slight earnings growth for the first half. And I think that's what the market's struggling with. Keep in mind, the S&P is still below where it closed December 3rd, right? So it's not as if the market has kind of gotten ahead of itself and said, oh, we're okay now.
Can I throw you a curveball? I don't know if you saw this stat over the weekend. Average tax refunds are down 8.4% in the wake of the Trump tax cuts. This is looking at tax refunds starting at the beginning of this year. Total number of returns received in the week is ending February 1st were 16 million. And down significantly. Do you think that's that could actually have an impact?
I think it's well, first of all, I think that's virtually the first week.
First week.
So it's hard to sort of project from that if that's what the season is going to look like. And it's usually, I think where the swing factor might come in this tax season is with higher earners who file later, might have to pay. That's where you might see the difference. So obviously the trend is lower. You had a shutdown. I don't know if people filed as much. So. It's not great, but I do think that with just 1 week's worth of data, I don't know what to make of it.
It's not a shock to anybody that lives in New Jersey or New York.
If you live in a salt state, there's no question.
There's no.
Usually the people who rush to file are expecting a refund.
Right.
And they're expecting a big refund.
Yeah, typically.
So then the question is whether if you built that into your the question is whether you think families budget for the refund.
Well, I remember the former CEO of H&R Block said, for our customers, the tax refund is the largest single financial event of their year, right? In terms of the single lump sum that they're going to look forward to or get. And that doesn't mean that they budget for it, but it means that it enables you to pay down some debt or do some deferred purchases.
Right. So, Nick, just the bottom line on what investors should really be doing. Everything you're saying seems to say bad, but not as bad as expected. So doesn't that mean that you shouldn't necessarily sell on this? That it might be an opportunity to continue to add to positions?
No, that's right. As the market resets higher to reflect that growth is actually going to occur in 2019 and not a recession, we don't believe that's fully reflected in prices yet. But to go higher from here, we need to start seeing the earnings estimates, which are getting cut and are going to continue to fall, begin to stabilize in terms of the magnitude downward. So we want to see estimates can fall, but not nearly as bad as what they've been falling over the past month or two. And ever since the Fed is now believed to be on hold now in 2019, we're seeing some of the estimate cuts that are occurring not nearly as severe. So that's a good sign. And that overhang that was coming from the Fed, where they were tightening the screws too much on the economy with raising rates, we get that overhang off. If we can get some sort of resolution with trade now, that's another overhang that can maybe allow for the expectations to start to improve and maybe even see some real acceleration of growth in 2019. That's being built in right now. So we have very low growth expectations in the first half of 19. By the fourth quarter of this year, growth expectations for the S&P 500 are back to 11 and 12%. So we'll see if that occurs.
Nick, how much of this is driven by Apple and the mega caps versus others in terms of the earnings picture this year?
It's those, it's a market cap weighted index, or the S&P 500. So when we do that, the larger market caps do impact the earnings more. But this is pretty broad based. In earnings season here, all 11 sectors are seeing their first quarter 19 numbers go lower after they report fourth quarter results. So in technology, where Apple resides, is one of the largest down. So that is a big driver. And energy is also driving the estimates down as well, the most. Those are the two sectors that are seeing the greatest cuts to estimates this quarter. And the defensive sectors, such as real estate, utilities, are seeing the least cuts. But all 11 sectors, the estimates are going lower.
The other thing, that theme also reflects the fact that it's overseas earnings that are pressured more than U.S., right? So technology is the most global sector in terms of source of earnings. That's been seeing the greatest revisions downward. So, it sort of tells the same story. You have global yields going down, global growth expectations going down, and it's pressuring multinational earnings more than domestic-focused companies.
That's correct. That is definitely correct. We're definitely seeing the slowdown in the global growth. And that's why when we talk about the trade wars with China, if you're long U.S. stocks right now, you want to see China's economy stabilize. You want to see some of these tech earnings start to stabilize. We've been saying win the trade war by a field goal, not 7 touchdowns. If China's economy goes too far south, Starbucks is going to sell less coffee, Nike's going to sell less shoes. We need to see China's economy stabilize to see some of these S&P 500 profits start to stabilize as well.